Hey everyone, it is Sterling here with the Euro Aussie. We're looking at an hourly chart of the Euro Aussie, and just real quickly I wanted to throw on the video because I'm in a short position on the Euro Aussie. Pretty rare that I actually take a short position on MT4, but for some reason when I went to take this position yesterday, couldn't log into MB Trading, and therefore I took it out my backup. So anyways, the point of this trade and what I wanted to get at was seeing manipulation on a little bit longer time scale charts. This trade was a great example of seeing a stop run above a clear hourly high. Now, we'll zoom out real quick and you can see the high that I was looking to trade from. So, the high here that we had established on the 28th and 29th of March 2013 was right around one spot 23.28 on, again, the Euro Aussie. So that was a very clear, well-established high. Why is that high important to me? Well, above any resistance point or above any major swing point, there's going to be two types of orders. There's going to be the breakout order for those that are looking to buy on the breakout. That's one type of buy order. And you're also going to have the stop loss for anybody that is previously short or did get short on the retest of that level. If you get stopped out of a short position, what do you have to do? You have to buy it back. Therefore, that is the second type of buy order that is often found above any resistance point, especially major resistance points. So, the really clear indicator about this and what validates the trade is when we see the market break above that point and show us the break above and very quick rejection back down below. Typically, this can be seen in a few ways. It can be a single candle pin bar that makes the stop run, meaning it breaks above the high probability point and then quickly gets rejected back down below it, all within one candle. You can see a set of railroad tracks that railroad tracks or reversal legs that breaks through that point, closes above it, and the next candle, in this case, engulfs it back down. Or right here, you have a nice evening star candle pattern. The bottom line is no matter what the candle pattern is definitely not the important thing. The important thing is that you're breaking, again, above that high probability point and getting rejected back down below. So a good tip to use, no matter what trading strategy that you do use personally, is when you see these false breaks of overall major hourly swing points, and you see the market create the false break, in this case get rejected back down below it, or in the case of a long setup, break down below the support and get rejected back up above it. When you see those false breaks of major swing points, and for example, if I were in a long position and I were to see this false push above this previous high, that's going to be a strong indicator that at the very least I want to get out of the trade. Well, in my circumstance, I wasn't in a position, and the reason behind the entry here was, when I saw that, the reason for me taking a trade on this was the clear stop run. So it wasn't to exit a trade, it was obviously to enter a trade, but either way it's critical information. It can be used in a few different ways. So that's really the key point to take away from this. Candles, throughout the course of any given day, you're going to see many candle patterns, and candle patterns tend to have a very wishy-washy success rate. You guys have all probably used candle patterns. I don't have to tell you the type of success you've achieved with it, because obviously you know what type of success you have achieved or haven't achieved with it. And if you're like everybody else, you haven't achieved a long-term consistent success with that. And the reason being is that the candles don't necessarily mean anything to us. They mean something when we see it at a high probability point, and when we see that high probability point breaking. So that was the gist behind this trade. Really illustrates the hourly stop run, how you can use this manipulation on longer time frame charts, not just the 15-minute chart where we do recommend. Another point, just to kind of illustrate the point, that although we look to mainly take our entries off the 15-minute chart, this chart illustrates a hourly stop run or hourly false break above a previous high. And although this illustrates the hourly, it could also and also does happen on larger time frame scales. So what do I mean by that? Well, let's go over to the pound real quick, and you'll have to excuse all the cycles that I have drawn on this chart for for essentially breaking down current market cycle. If you're familiar with the site, you understand what I mean by current market cycle. So on the daily chart, because the daily chart is not used for breaking down cycle, it looks a little compacted. But on the hourly chart, it breaks down into 1, 2, 3 cycles to each side, and that's how we determine market cycle. If you don't understand market cycle, we're not going to get into that. It's not the point of this. There's a lot of information on the site if you want to check that out. The point of this is to show a daily stop run. You look at your pound chart and you look at the daily chart, and looking at the pound, we have a very clear, well-established high here at 1.6296. That's also a psychological barrier right around 6,300. It's not a coincidence, and I'll delete this one line so you can see that spike. It is not a coincidence that the market breaks above that high before starting this last run to the downside. You go back and look at the euro in 2008 and 2009. Look at the double, essentially the double top it created, but what was the last high doing? The last high on the euro, and actually let's go take a quick look at that. So flipping over to the euro here, we'll look at really the exact same thing. This is a daily chart. We'll zoom way out, and I'll go back to one example just off the top of my head. There's many more throughout this. Obviously, if you're to go through and look, and especially on a little bit smaller time frame charts. But if you guys are around during this time, this is a huge deal. We had the euro breaking through the overall highs. We were coming up. We were testing all-time highs on the euro, and the market comes up to 1.6000. It pushes through 1.6000, then it pushes through the previous highs. It's not a coincidence that the market creates that false push before turning the opposite direction. So what's the reason behind that? Well, if smart money has the ultimate intent to short the market, and again we're looking at the euro on the daily, so if they want to short the market, what is the only way that smart money can short the market? Well, the only way they can move hundreds of billions of dollars over the course of days is by either inducing buying pressure when they have the desire to sell, or inducing selling pressure when they have the desire to buy. You have to have a buyer if you want to sell, and you have to have a seller if you want to buy. For you and I, liquidity will never make a difference. We are too minuscule to ever have to worry about liquidity in the Forex market. For the banking industry, that is their only worry, and that's why this manipulation is what we track on a daily basis, because they have to, again, create the other side of the market in order to enter positions as well as exit positions. So by breaking above that high, they induce buying pressure. They're stopping out anybody that was short, which again triggers a buy. To cover a short, you have to buy it back. They're inducing that type of buy order, and they're inducing those that are buying on the breakout. So they induce a ton of buying pressure by breaking above that previous high. And again, why would they induce buying pressure? Well, you have to have a buyer if you want to sell. And immediately selling into that buying pressure, price snaps back. We see a nice runoff from there. You go over to the pound, and the pound is another example of that. Again, it's not a coincidence. Before a huge push down, why do you see the stop run? This happens on a 15-minute chart, which is where we take our entries from. It happens on an hourly chart, where I'm looking at the Euro Aussie. The manipulation is something that is extremely obvious, and what's great about it is based on an individual person's schedule, they can adjust to trade according to the times that they're able to. Preferably, people will follow it the way we have it laid out. For those that need a little different schedule, the strategy allows for that little different schedule. So at this point on the Euro Aussie, as far as trade management is concerned, at this point what I'll be doing is closing the position, and the reason for that, although we may have a little more downside, what I mean by the fact that we may have a little more downside is you go out to the daily chart, you can see that on the daily chart we have a nice clear low here where they could create the stop run at that point. That point is about, at this point it's 70 pips away, 70, 75 pips away. Going back into the hourly, we're at essentially an overall daily swing point low. So I just have a worry that they're going to create the stop run here, possibly push the market back up. You know, they very well could run it to those lows. There's a risk in holding a position. There's obviously a risk in getting out of the position, giving up some potential profit. At this point, Why would I exit? Well, number one, going into this trade, you can see from my entry point on this initial pullback, the high was only about 17 pips away. So in this example, because it was an hourly chart, pretty rare that I use a 25 pip stop, but on an hourly chart, a 25 pip stop is quite good when you're talking about an hourly move. So at this point, even factoring in spread, right now we're about 96 pips up. Takeaway spread on, generally with the Euro Aussie, because you have a higher spread, you're talking 5-6 pip spread. So even still, you're talking close to 90 pips. So based on a risk reward perspective on this, on this given position, you're talking 3.5 to 1. Risk reward is one of those things, along with a few trades per week, is what tends to differentiate traders that maintain successful profit over the course of time and traders that tend to struggle maintaining consistency. Over the years, one of the things I've learned is that risk reward far exceeds a win-loss ratio in importance. And so when I see something like 3 to 1, 3.5 to 1, 4 to 1, I'm extremely happy taking the profit there, and that's the case with this position. So we'll go ahead and close this one out here, and we'll call it a day. Officially got the close at 122.36 and had an open of 123.23. So overall, nice trade, 87 pips overall, roughly. And I will take that one all day and move on from there. So I hope this video helped you. If you have any questions as to why I took the trade, if there was something about the video that didn't make sense, feel free to shoot Chad and I an email. We'll be happy to get back with you. But again, I hope this video helps, and I look forward to seeing you again. Till then, happy trading.